Welcome to Gold Compass Guide, where macro signals, gold insights, and wealth protection strategies help you navigate uncertain markets. To understand where markets may be heading next, it helps to pay attention to what's happening quietly, away from headlines and daily noise. Gold versus silver, two precious metals, often grouped together, often compared, often debated. But they are not the same asset, and understanding the difference could change how you think about risk, volatility, and long-term wealth protection. There's often excitement around silver. Talk of explosive upside, talk of shortages, talk of silver outperforming gold. And sometimes that happens. But gold and silver play very different roles inside the financial system. Today, we're going to break down those differences calmly and clearly, so you can understand what each metal actually represents. The first major difference between gold and silver is purpose. Gold is primarily a monetary asset. Silver is primarily an industrial asset, with monetary characteristics. Gold is held by central banks. Gold sits in vaults as a reserve. Gold functions as financial insurance. Silver, on the other hand, is heavily used in industry, electronics, solar panels, medical equipment, manufacturing. That industrial demand changes how silver behaves. Because silver has strong industrial demand, it tends to move more aggressively during economic cycles. When growth expectations rise, silver can surge. When economic activity slows, silver can fall sharply. Gold behaves differently. Gold often rises when uncertainty rises. Silver often rises when optimism rises. That alone explains much of the price difference between the two. Silver's lower price per ounce also creates psychological appeal. It feels cheaper, it feels more accessible, it feels like it has more room to run. And during bull markets, silver can move faster than gold. But that speed works both ways. Silver historically experiences deeper corrections than gold. It is more volatile, more cyclical, more sensitive to sentiment. Gold tends to move slower, but steadier. Gold has a unique position that silver does not share. Central banks hold gold. They do not hold silver as a reserve asset. That distinction matters. When institutions seek stability, they turn to gold. When investors seek acceleration, they often turn to silver. Gold protects purchasing power. Silver amplifies cycles. There's also something known as the gold-to-silver ratio. It measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio rises, silver is underperforming gold. When the ratio falls, silver is outperforming gold. Historically, silver outperforms during strong bull markets. Gold outperforms during fear-driven markets. Again, different roles. If you're thinking about risk, this is where clarity matters. Gold is typically held for stability, for wealth preservation, for protection against systemic stress. Silver behaves more like a hybrid, part monetary metal, part industrial commodity. That hybrid nature makes it potentially more explosive, but also more vulnerable. Gold tends to shine during uncertainty, recession fears, currency instability, geopolitical tension, financial stress. Silver tends to shine during expansion, manufacturing growth, industrial demand, optimistic investment cycles. They are not competitors. They are different tools. The hype around silver often comes from its potential for outsized gains, and in certain cycles, that potential is real. But gold's role has always been different. Gold is about resilience. Silver is about opportunity. Gold is about insurance. Silver is about amplification. Understanding that difference allows you to move beyond hype and toward intentional positioning. The goal isn't to declare a winner. The goal is to understand the role each metal plays. Because in uncertain markets, clarity is more valuable than excitement. If you found this helpful, consider subscribing to Gold Compass Guide. We'll continue breaking down gold, macro signals, and wealth protection strategies, calmly, clearly, and without noise.